Well, hello everybody. This is Ken Himmler, and welcome to another show of the Wiser Money Show. It's been a little while since I've connected with you, and there is a good reason for that. I was about ready to do a show on November 4th with the intent of, following the media of what do they call that, the red wave of the GOP, and apparently that didn't go through. So as I saw the results, kind of waiting and counting, and Nevada, I mean, like the 1800s, let's count these things by hand. So I decided to put the original broadcast in November off for a little while until we had some better results so that I would have something concrete to share with you. And here we are at the end of November, and there's still nothing concrete. I mean, well, there is concrete to the point where I am comfortable in talking about what I see as some of the economic drivers and some of the decisions to make. However, as you all know, if you've watched any kind of the TV lately, Georgia is still up for grabs, and we're still waiting on that. But we have some outcome of the results of how this will play out, in my opinion, on an economic front. So let's talk about cover what we're going to talk about today. Got a couple things. We're going to talk about the midterms, inflation. We're going to talk about, let me move this camera over a little bit so I can see what we're talking about here. We're going to talk about unemployment. We're going to talk about interest rates, stock market, housing, recession, and I have a new version of an econ map. So let's cover that. Well, election results, let's start with that. So first off, the midterm Senate results are, as you can see, 48 on the Dems, 49 on the GOP, but we're still holding out on Georgia. It looks like it's going to go to the Democratic side. But then we have the House, and it looks like the GOP has won more seats, a majority within the House, and that's pretty much concrete. There's no question there. All the results are in. And what to expect? Well, as politics, the high school on steroids of politics, high school drama on steroids of politics, we can probably anticipate a lot more drama on TV. The investigations of the Biden family, and it just goes back and forth. I don't know. I just think it goes back and forth. It's just such a waste of our taxpayer money, our time, our resources. We've got real problems in this country. And that's a lot of energy put just towards, I don't know. Again, that's probably why I'm not a politician. What this will mean with the House is we're going to have a lot of stalled agendas with the spending. Well, it just means that there are certain executive actions that can be taken. We've seen every president since this has been allowed do that. Biden, as an example, with the post-pandemic. So we all know that the student loan forgiveness, which I was never in agreement with. Again, it should never have been a freebie at the taxpayer's expense. It's not social. We're not a socialist country. We should not just spread the cost of that. It's not a social program. It's not like Social Security. It's not like Medicare. It's somebody chose to go to school. They had the debt. There are people that did get ripped off by certain things, and I agree that's something that the government didn't do their investigation, so they should cover it. But as a majority, the almost trillions of dollars that they're planning on paying off, well, as we know, if you've read or watched any of the news, which is hard to get away from right now, that the media says that, or Supreme Court says that, technically a Fifth Circuit court judge in Texas has ruled that Biden's student loan forgiveness program is illegal. So now it's going to go to the Supreme Court. And in this time that it is working through the court systems, what Biden has done is the executive action. So he's claimed we're still in a pandemic era emergency, and he was able to freeze or defer the payments on the student loans. Well, the problem I have with that is what you'll see in a few minutes about what the reality of where that money is going to go when it's forgiven. So let's cover inflation for a minute. Right now, from my calculations, we are at about a 10.5% or 11.5% inflationary rate. The government says 10.5 trailing based on certain items, but again, the government can adjust those items. They can take out and swap things under the way that they calculate inflation. I'm anticipating an 8 to 10% increase in Social Security, but remember what I talked about. By them increasing the Social Security to a certain limit. They have not increased the taxation limit. So if you're single, it starts at $25, and if you're married, it starts at, I think it's $33,000 or $34,000, where they start to tax 85% of your Social Security benefits. So that old saying, what the government giveth, the government will taketh away. Because what will end up happening is it will push more people into the tax on Social Security. And then it will also trigger Social Security tax in a lot of states. Not every state allows that as tax-free income. So inflation is going to continue, and it's going to continue until they stop giving away free money. The savings, and again, you only are going to reduce inflation when there is a pressure on labor and there is a pressure on the supply chain to be more productive. And you cannot do that when the government keeps giving away free money. It just can't happen. It's in every period in history, every time that the government has tried to do that. I mean, look at the failures of communism. Look at the failures of socialism. It does not work. We humans, we need to be under pressure. If you give everything to a human, it's nature. I don't know if you ever heard about that one scientific study that was done where the scientists thought that they could increase the production of chickens hatching. So they created this little machine that would assist the chickens in hatching. It would remove their struggle. But what they found is that when they actually assisted the chickens in hatching, more chickens died. And one of the reasons is nature says that you must struggle to be strong. There's hormonal releases that they learned about. There is things that go into that chicken's body to make them stronger. So when they were assisted on exiting the shell, more died. This is no different than giving away free money and expecting that the inflation rate will come down. It doesn't work. You can't give it away. People have to work. They have to become productive, and then inflation will come down. So let's talk about unemployment. Well, unemployment is at a very, very low rate, but it doesn't mean that people are productive. Have you been to a retail store lately? Have you been helped? Have you tried to call 800 numbers and you can't get through? Have you been to a restaurant lately and found that the service isn't that great? We actually just went to a restaurant, and this is a restaurant that we're normally used to going to, and we buy our daughter a salmon, a little side of salmon, and this side of salmon was normally about $10 to $12, and the salmon was it was a good size. Prices were exactly the same, and that salmon now was this tiny little bit. That's called shrinkflation. That is where they keep the prices the same, but they give you half the portion. So these things will have to change, but they will only change when you let people struggle and you don't make it easy on them. So again, we only have 62% productivity in 2020, and now in 2022, and again, normal productivity is up in the 70s, and now we're at 49% productivity output. That is just terrible. So let's talk about interest rates. Well, the Fed wants us to get back to a 2% inflation rate. And I can anticipate, and this is kind of the scuttlebutt, is the rates to come will be about 25 basis points, 0.25, a quarter of an interest of 1% in December of this year, and then another in January. And this will only help inflation, and it means that interest takes time for people to run out of reserves. If you keep giving them reserves, they will continue to go out and spend. It will not help inflation. So the typical turnaround time when you raise rates and when people start to work their reserves down and they stop free spending is a 6 to 9 month actualization. And then in real estate, it takes 12 to 24 months for that to actually take effect. So again, the fake politically motivated free money, it must stop. So I told you I'd tell you this. So there's a recent study that was done, and they interviewed, a couple thousand of these people that are going to be the beneficiaries of the Biden student loan forgiveness program. 62% of them, when asked what would you do with all that extra money, They said that they were going to spend it on travel and entertainment, primarily going out to dinner. That is not going to help inflation because food was one of the largest contributors to the inflationary effect. Well, housing, let's take a look. We're not doing any better, but it is following along the exact trend line. If you've been following this show since beginning of 2020, and I had version 1 back then, and I made some predictions on the housing market. I did not predict correctly on 2021 where the housing market went up 20% because I did not expect that could even be sustainable. And so now when you look at what's happened with the housing market, what will happen when it adjusts backwards will fall in line with my original predictions. So my original predictions were off for about 6 to 8 months in the housing market. But if you have watched this show for any period of time, I have repeatedly said, do not buy real estate. Do not buy it. Because now if you try to sell your property, some people say, well, I could have bought it and I could have sold it. Yeah, if you timed it right. But we have discussed this and I've helped you with this to understand that market timing is a risky game. And at least if you go to Vegas and you gamble and you lose money, they at least comp you a room and some drinks. You start trying to time the stock market and the real estate market and you lose. That hurts. There's no benefit to it. So my expectations are that within the next year and a half, we'll see at least a 20% drop in the current real estate market prices. They've already dropped about 10%. So that'll be about a 30% decrease. Now remember the difference. You can't say, hey, I went up by 20% on my property, and so if it goes down by 20%, I'm okay. No, it doesn't work like that. That's an arithmetic calculation versus a geometric calculation. And what I mean by that is, let's say that you bought a house for you had a house $100,000 and it went up by 20%. Now you have a $120,000 house. Now if it goes down by 20%, you have a $24,000 drop. Now you have a $96,000 house. So again, you have to be careful that you're not calculating things incorrectly when you're making financial decisions. So what is a recession? Oh, the news is out there. Recession. Am I worried about it? Not a bit. And why? Good things happen when bad economic things happen if you know how to arrange things. You've heard me say this over and over again. There were more millionaires minted per capita in the Great Crash of 1929 than in any other time in history. Why? When things drop is when you find great opportunities. So what does it mean to you? Is it really important? Well, it's going to affect mortgage rates, housing prices, food prices, savings per capita, debt per capita. And really, the question comes back to, how do you have your buckets segmented? That's really what it comes down to. If you have enough in your bucket 1 and 2, the recession isn't going to matter. Because again, you have a 10-year structural plan. If you don't, and you're trying to ride the macro and microeconomics, and you're trying to outguess them, good luck. Because there are really smart people in this world. And, the economists, they say 75% of them get it wrong. Because they're making guesses as good as you. So again, I'm not suggesting that you guess. I'm suggesting that you have a plan in place. Now, here's a great example. Let's take a look at what the stock market has done. This is as of this morning. The Russell 2000, over the past 5 years, it's up 21%. But when you look, people are like, oh, small caps. I shouldn't do small caps because, the trend is whatever it is. Whatever the most recent trend of the day is in media. But you can see there, if you go back 5 years, it had a huge drop in 2020. It peaked out. It's now middle ground, but you still have over a 4% rate of return with a 2% average inflation for the prior 4 years, right? So it's still not bad. Now we take a look at the S&P 500 for 5 years. Well, it's up 52% in 5 years. So if you say, well, wait a minute, it's down this year by whatever it is, you'll see in a second here, but over 5 years, it's still up over 10% per year, right? So, and by the way, That's a geometric return, not an arithmetic return. Big difference. Okay, now we take a look at the Dow. Look at the Dow right now. It's down 6% year to date, right? Year to date. However, when we look at the past year, it's only down 2.25. That's January to right now versus December of this year. Well, November technically, right? To November of last year. And then we look at the Dow over 5 years. Well, 5 years, it's still up 41%. I hope that you're really taking this in. And you're not just looking at the numbers, but you're recognizing the understanding of the math of how the three bucket system works. And why when you apply that, and when you utilize that system of reverse engineering, why you can sit back and you don't have to worry about all the media garbage that's out there. Because look, it's still up 5 years. And that's the strategy. So what is a short-term reaction versus a smart decision? Well, reactionary decisions, you sell because the market went down. We've never seen this environment before. I hear this over and over again. Yes, we have. You're talking to a guy that studies this stuff. And we have seen this environment over and over again. It's a 8 to 12 year cycle. So when you hear people saying Chicken Little, the world is coming apart, the world is falling down, this has never happened before, it has. It has, absolutely. Go and really study it. Don't take the media garbage that's out there and listen to them telling you this has never happened before. It has. And so you hear these people like, it'll be the decade of loss. Well, let's have a little memory reconnection to our famous example of Alliance Money Hedge Fund, Bill Ackman. Let's remember what he did in June of 2020. He says the world is coming to an end. I can see the market dropping another 40%. I can see, just long-term recession. Well, he's this respected multi-billion-dollar hedge fund manager, right? So what do you think the average? Oh, Bill Ackman knows what he's doing, so I better sell. I better put my money in cash. Do you know that when he was putting that media out there, he had shorted the market, and he had used $25 million to short the market. He walked away with almost a $4 billion profit. Yeah. I mean, listen, if people are really listening to the media and they lose money, it's on them. They should know that the media is slighted towards getting what they want. The media is paid for by the advertisers. The advertisers want a result. And keep in mind, the more emotional turmoil that the banks and the brokerage companies can create, remember, they make money every time you buy and every time you sell. So if they can create greed on the way up, they're making money because you just bought, and they make transactional dollars. And then when the market dumps and they can scare you and you have to sell, they make money again. So let's realize what this circus is all about, and let's make some smart decisions. But a smart decision is not to sit cash in a money market or a CD, not when inflation is sitting at 9-10%. You're making maybe 2 or 3%. You got to fix that because you cannot recover over time. And let's also look at what the biggest risk is. It's inflation, number one, and number two is taxes. Because there's all these people out there, and they'll see the market go up, and they'll get scared when it starts to go down, and then they sell, and they pay tax 20, 30, 40% on their gains, and then the market goes back up past where they sold at, and they have not bought in. So now they got a double whammy. They lost money on the upside, and then they paid tax on all the gains. It's insane. This is like 40 years of me doing this. And sometimes I get frustrated at it, and sometimes I just get disappointed and sad that people continue to make the same mistakes over and over again. Okay? Let's take a look at the key indicator changes. New home sales are down 25% in October. Personal savings rates have dropped from over 6% to 2%. This is the 1921 flu epidemic repeating itself all over again. Personal debt per capita increased by 21% in 2021. If you want, go back to the March, April, May broadcasts that I did in 2020. And I said this will be a repeat of the 1920 Spanish flu pandemic, which ended up in the Great Depression of 1929, 9 years later. I also have said that it's not going to be anywhere near that because, again, they didn't have the SEC, they didn't have banking regulations, they didn't have all the protections that are in place today. So it will be a downward trend. But again, this is not something that I'm telling you this because I want you to time it. I'm telling you this so that you can be prepared emotionally, but never, ever change your financial structure. You can make little modifications within it, but don't try to trend it. Don't try to outguess it. Because again, here we go. Personal debt, same exact thing that happened back in 1921. You heard all these stories about people losing their houses. Well, you know why most people lost their houses? Because they went out and took mortgages that they could not afford. Sound familiar? Right. Interest rates on mortgages have increased to 7% and more to come. And here's the thing with property. See, what a lot of people say is, well, that's fine. You know, it's 7%, but I already bought my house. Let's keep in mind, as those property values increase, you're paying more in property tax, more in insurance, and it may become unaffordable for a lot of people to hold on to them. So you say, well, as long as I hold on to my real estate, it shouldn't lose value. Listen, if you have a neighborhood and there's 100 people in the neighborhood, and out of those 100 people, 25 people cannot afford to keep their house, and they have to sell it at fire sale prices, do you think that that is going to reduce your value? Of course it will. And so you take a hit because of other people's emotional response. You've heard me talk about this in mutual funds. Same thing. Why I do not let clients stay in mutual funds. Same thing. You can take a financial hit because of other people's emotional instability in making good financial decisions. Listen, in the 2008 stock market and real estate market crash, what was that due to? It was due to banks giving mortgages to people that shouldn't have gotten mortgages. In 2024, I think when the recession really pulls back a lot of real estate, it's going to be due to the government giving away free money. It will. So let's talk about our econ map, okay? So I'm still running at about 82 to 85% accuracy within about a 3-month tolerance on this econ map. If you go back and watch every one of the episodes that I've done, which is pretty good because I'm not trying to make predictions so that you can move money, so that you can buy or sell. Again, this is so that you can be prepared emotionally, but you should still have a foundational plan in place. Stock market, well, I said, in January, go back to January's, I'm telling you this because a lot of people say this is going to happen. Great example is Robert Kiyosaki, Rich Dad, Poor Dad author. If you see the stuff that he produces, last October, he said that the world was going to come to an end. It was the best October, November, December of the stock market. That year ended up almost 28% up. Then he says it again, and then he says it again. So I'm telling you that I have these recorded. You can go back and look at exactly the algorithms that I created and exactly where we are right now within the system. Okay, so the stock market, I anticipated it's going to be a crazy year in the beginning of the year. I wasn't planning on Russia invading and that changing things. That dumped it even a little bit more. But I believe that there's stability back. But I believe that the stock market will go up until the fourth quarter of next year. Again, please do not take what I'm telling you to try to time the market. This is only so that you can be emotionally prepared so that you're not losing sleep. I do believe that unemployment and productivity is going to continue down until probably the end of 2023. I don't think that there's going to be enough pressure on employees to be productive until it really hurts, which means that there will be a crossover in inflation. Inflation is going to continue up till the end of next year because people still have a lot of money to spend. Well, interest rates, again, they're going to go up with the Fed's genius crystal ball that they think that they're going to be able to control inflation with interest rates, which they've been wrong. If you look at the statistics, they've been wrong 78% of the time. That's not exactly like if somebody said to you, okay, we're going to take you to boot camp in the Army, and we're going to teach you how to cross a minefield. And the way we're going to teach you is 78% of all the people die in that minefield. but you got a 22% chance of survival. I'd probably go AWOL if that was the case, because I don't want to learn from that type of trainer. So again, I think real estate in the end of 2023 and going into 2024. Now, why would I tell you this? Well, if you do plan on buying a house, if you plan on buying any major appliances, if you plan on buying anything major, I wouldn't do it now. I would wait until mid to end of next year, and I think we're going to be in a completely different environment. I'm not telling you that to time the stock market or to time real estate investments, but if you're going to buy a personal home, hey, don't do it yet, okay? Now, the midterm elections, well, this is going to affect everything from taxes, interest rates, inflation, employment, because it will stall some of the excessive spending that this administration has proposed, right? We saw where the Colorado senator's wife got caught on camera stating that, yeah, we knew that this bill had nothing to do with green environment or inflation protection, or this is really just all about having some extra cash in there to further our agendas. Come on, that's always going to be politics, right? All right, so let's talk about 2022. The actions, why did we not rebalance? Well, stocks dropped up to 26%. If we sell bonds, because remember, that's what a rebalance does. It would sell the bonds to buy the stocks that dropped. We would have reduced the bonds. Well, why did we not want to reduce the bonds? Due to rates going up. Remember, when interest rates go up, bond values drop. So if we would have rebalanced, we would have sold the bonds at a loss. That's not our intent. The intent of rebalance is you sell something when it's high to buy something when it's low. When they both double dip down, you don't do that. So if we would have sold the bonds, that would have sold the bonds at a loss to buy stocks that were lower. But again, if we did that, all that would have done is thrown more into bucket 3. And we have a very structured system to make sure that we are keeping your buckets in tolerance to provide for that cash flow and that security. So again, we also, holding the bonds and rolling ETFs, we saw some short-term downward pressure in the ETFs, but the key with the ETFs versus a mutual fund and versus individual bonds is that they're rolling. If we would have sold bonds to rebalance into stocks, we would have sold at a loss, or downward pressure at least, and we would have missed out on the upward increase in the interest rates that those bond ETFs are paying. So the conclusion, in a double dip year, like we had in the last 10 months, right? You don't go into rebalance just to create activity. We're going to rebalance when we see mathematically that it is in the best interest for you. We're not going to rebalance because people will look at it and go, well, what are you doing if you're not selling and buying? We're researching these algorithms and we're researching every move. So the amount of time that we're taking is actually to make the right move. And sometimes not making a move is the right move. But the time in the research to determine if it's the right move is the work. That's why people hire us. So now, here's another question I've gotten a lot of. Well, why didn't you buy tips when they were going up? Because you don't buy tips when inflation soars upwards. Because what happens is the feds will increase interest rates. So if we would have bought tips, say in March, those tips would be down in value right now anywhere between 10 to 20%, depending upon the maturity. Now the offset to that in the short term is a tip will pay a higher interest rate. But remember, the interest is calculated on the then current inflation. So if interest rates go up, bond values go down. So if we would have bought tips, we would have seen that asset value going down. You would have seen a short-term increase in the interest rate. But as inflation comes down, the interest rate comes down. It doesn't work like a normal bond. See, in an ETF bond, we can buy those, and they might have maturity dates of 5 to 7 years, paying 5 to 7%. We get that 5 to 7% until its maturity. But if it's in a tip, You're only getting it on the short-term inflation. So if inflation comes back, you could own a bond that lost 20% of its value, and you originally got 8% on the interest rate for the first 6 months, but then the interest rate drops down to 2% or 3%. So now you got a double whammy. You got lower interest than a rolling ETF bond, and you got a depressed value in the ETF itself, inside of the TIP itself. So again, to answer some of your questions of why didn't you buy TIPS, that's why. And again, sometimes not making a move is the smartest move. So what am I estimating going forward into 2023? Well, I think between February and June, my number one goal is to really study the debt ratio per capita, study what interest rates and how they apply to the rates and reserve decreases of the average American, because that has a lot to do with inflation. Number two, that's number one, I guess. Number two is every one of our clients, we're going to be recalculating all of our e-money reverse engineering into our buckets for next year, because inflation has affected a lot of people. Social Security is going to be a huge effect. Property tax, interest rates, insurance is all going to be a big effect. And we may adjust some of the bucket allocations, okay? Now, in the first quarter of 2023, my anticipation, again, I always hold this in reserve. I can tell you what I think we're going to do, but until we actually do the calculations, I don't make predictions that, hey, this is what we're going to do 4 months out from today. What I do see, though, is reducing some of the international allocations and pushing more into the domestic coverage, as well as moving some of the shorter term bonds into the longer term positions. Because now that interest rates are close to peaking out, that's when we want to go short term to intermediate or longer term. Still in the same bucket strategy, same in the allocation. We're not changing that structure. But I do not want to buy long-term bonds while they're still increasing interest rates, because again, that will depress the value of that bond. What are some of the actions you can take right now? Number one, please do not reduce stock. Don't do that right now. That is just a mistake. Tax loss harvest, especially if you still have some things that you can tax loss harvest before the end of the year, take advantage of that. Some people say, well, I can only write off $3,000. No, you can't. You can write off $3,000, but any losses can carry forward unlimited years until you have a gain. And you could use that on real estate, or you could use it on securities and equities. Again, compute your cash flow needs for the next 5 years. That has to be recalculated considering the change in inflation. I would not invest in real estate right now. Again, personal transitional, if you're selling a $500,000 house for a $500,000 house in a different area, well, you're not investing. You're not upping your investment in real estate. You're just more exchanging it. Again, I would use rolling ETFs, bond ETFs, to offset some of the changes in interest rates and inflation. And here's the big one. This is a huge one. Assure that your bars are books and records. These are your tax records. And if you own a business, you have an LLC, you better make sure that they are perfect. 87,000 new IRS employees are being hired. And we are already seeing a massive amount of audits that are used as training audits. This is where they hire a new person. They go out and collect all the data and they do the initial audit, and then they have a senior auditor handling 5 to 10 of these new auditors, but they're using you as a training ground. And you better have your stuff in order, and it better be clean, right? Again, also use rolling ETFs to capture some of the upside, even in some of the stock portfolios. All right, well, thanks for joining me today, and hopefully this is a good update. And again, now that the midterms are over, we'll up the frequency of our broadcasts. But if you have not yet subscribed to the YouTube channel, just Google H&H Financial Center on YouTube. You're going to see this page in front of you. Just hit the red subscribe and you'll be able to get notifications whenever we post these. And if you have any questions in closing, just dial our number, 844-702-1040. Again, it's 844-702-1040, because I know some of you are listening to this while you're driving. Or you can email us at support@hhtba.net. And with that in mind, have a great week.